90 minutes into the trading day, stocks, they are falling to start the week as investors await clarity on trade policy and as President Trump calls for Fed Chair Powell to cut rates. Joining me now, we've got Max Wasserman, Miramar Capital founder and senior portfolio manager. Good to see you. You say de-risking portfolios would be prudent. How can investors implement a de-risking strategy right now?
Well, it's good to see you. And we've been stressing de-risking for the past 6 months. And what that means is look at your risk tolerance. We think right now that the Nasdaq has been overvalued or priced for perfection for some time. And in a market like this, where the uncertainty level with tariffs, higher interest rates longer, we were telling people, and we're still telling people, to lower your exposure to the Nasdaq. Trading at 27 times earnings, we think is just too rich, and it's dominated by a handful of stocks. Also, we think focusing on shorter term in your bond portfolio, which takes away the risk of higher interest rates creeping up. And so we're telling people shorter term on bonds, and we're focusing on dividend paying stocks to help pay you while you wait, because the volatility in this market is self-induced. It's done by policies. It's also done by a second big thing, which is stagflation, which appears to be happening in this market. So interest rates are staying higher longer. And the fact is the Fed is being hesitant to cut interest rates in an environment like this. So we think there's a lot of risk out there, and we're cautioning investors, just really know what you invest in, lower your risk profile a little bit by taking, I would say, take a little more off the table in the Nasdaq area right now.
You know, it's great advice. And Max, I wonder, for the self-induced nature that we've seen play out here, as you've seen some of the moves higher, at least in the interim period of time, the dead cat bounces, if you will, where should investors be kind of thinking through or going through their checklist on where to and where not to kind of chase that move higher, even if it is on a short-term basis?
Well, I think the first thing investors have to understand is what is their time horizon, and understand that we go through this volatility. This isn't the first time this has happened. We had it in 2018. We've had issues in 2022 when the Nasdaq was off 34%. So I think they should understand what they own. I think they should really focus on buying good qualities. We prefer dividend paying stocks and high quality bonds. This is not a time to try to trade off the bounces and the lows. Just own good quality companies, short-term high quality bonds, and just prepare for volatility. We've seen things like this before, and understand this can change in a heartbeat if you see policy changes. So you don't want to be caught just out of the market, but you just want to lower your risk profile.
Max, while we have you, we're amid earnings season, and of course we're waiting for some of the larger technology names, but one of the names that has been the poster child of earnings seasons past because of all the fervor around the AI trade has been NVIDIA. Is there a new bellwether that investors should be looking towards with the market environment as it is right now?
Well, in technology, I don't think that there is a new bellwether. I mean, people should focus a little bit on what exposure these tech companies have to tariffs and where their markets are. I mean, do you take Apple, for example? They have a heavy exposure to China. Amazon has exposure to China with the goods that they import. NVIDIA and a lot of these stocks have already come down substantially. It doesn't mean they can't come down another 10, 15%, but we think they're reflecting a great deal of stress out there in the marketplace. But as for a new leader in technology, I don't think there are going to be new ones. We still we're invested in the Microsofts, we're invested, in the Googles, we're invested in the Broadcoms. It's just we understand that there's going to be some rough times ahead. But for new leadership in technology, I think it's the old ones still there, just at a cheaper price.
And so with that in mind, who are your top picks right now as you're assessing the best opportunities to play in the market?
Well, for us, again, we're going to try to lower our risk. I mean, we do like the tech, we do like pharmaceuticals. AbbVie is a big holding of ours. We like it here. It's paying almost 4%. We like defense stocks like Lockheed Martin, General Dynamics. Again, they're paying you almost 3% Lockheed, 2.25% on General Dynamics. We think they're there. Another good company we like is Waste Management. I mean, they bought Stericycle. And if you look at Stericycle, basically they're going to give you 6 to 7% EBITDA growth with healthcare. So we like those type of companies. CME is another one we think is going to take advantage of all the volatility because they're basically a tunnel, if you will, that passes through when people are trading more in financial options, currencies, oil, and they're leading in crypto in terms of, and there's basically no credit risk with CME. So we really like that. It pays you about a 4% dividend. They give you 5 dividends. They give you a special one at the end of the year, so we like that. But what we're saying is look outside the 7 tech companies. They're good companies. I would look for them to go a little bit lower just due to uncertainty. But we think pharmaceuticals look good. Consumer staples, we like some of them there. There's a lot of stocks out there. But again, the market's more than 7 stocks. And we've been telling clients forever, basically, look outside where everybody else is. And if you do that, you'll see less volatility in your portfolio as we're experiencing.